Welcome back. You're watching us on Mutual Fund Corner. We're discussing retail ownership in the stock markets, which is at a near 1% high. And we do have Tarun Birani with us. He'll just join us in a bit. In fact, you know what we were discussing with Firoz, we were talking about, whether there is some merit in investing in PMS versus investing in the most concentrated, focused mutual funds. And over various parameters, be it risk, be it return, or be it risk-adjusted returns, we've seen that the concentrated, focused mutual funds gave much better performance. So the last 3 years, 1 year rolling, has been close to 16.6%, whereas the risk has been, measured in terms of standard deviation, has been just 20.86. Importantly, for investors, the return per unit of risk taken has been higher for concentrated, focused mutual funds as against assets under management with a 3-year history. So, be that as it may, going forward from a long-term standpoint, Firoz does make the case that if you uncomplicate it and invest in most concentrated, focused mutual funds, you're likely to be better off. But then again, there are a lot of people who do get the thrill out of DIY investing as well. So, we do have with us Tarun Birani of TBNG Capital Advisors. Thanks a lot, Tarun, for joining in. And that clearly is, the first obvious question. How easy or difficult is DIY stock investing?
Right. So, good afternoon. I think the first part which you mentioned about DIY investing, most important part is it requires a lot of expertise and time. And I'm not sure most of us have the capacity to give that kind of time, as well as invest that kind of time to understand each of the stocks where we are investing. So this is one of the most important part to my mind. Again, the most important issue with DIY investing or do it yourself is behavior management. And behavior management, if you ask me today in a bull market, if I ask you a question that how much decline are you ready to bear? And people will happily talk about a 20-30% drawdown is also okay with me. But when it comes to actual market fall in an environment like a pandemic, which happened last year, or a 2007 or 2008 environment of a Lehman crisis, people react to that situation in a very different way. So DIY investing is a very tricky one, and people end up losing their behavior. They get into herd mentality. So the returns, what they make in 6 months, they lose it in 1 day in that environment. So, and again, Vanguard has done a very beautiful study where investing yourself versus investing with a goal-based investing mindset, there is a almost 3 to 4% extra returns which can be achieved if one do a focused goal-based investing, because there you would be rebalancing properly, you would be managing your behavior based on your financial goals and not investing based on the market behavior, right? And again, a self-attribution bias is also an abeyance when you invest with a goal-based mindset versus a DIY investing.
Right. In theory and practice are the same, said Albert Einstein, but when it comes to practice, managing behaviors are extremely difficult, like you said. We did speak with Firoz just a short while ago, and we were wondering that these are not mutually exclusive, right? People can actually do some DIY for their own thrill as well, at the same time invest in mutual funds and get in some advisors too. So do you think that would be a more prudent approach, say allocate some amount of your capital for your own investments, for your own thrills, and then for the bulk of it, use the help of an advisor?
Right. So I would always like everyone to compare it with 3 important variables. One is a performance, another is efforts, and third is the cost part. One need to review, and one can make a 50% portfolio where you are investing yourself and 50% you are investing with a goal-based long-term investing mindset. And if after, let's say, 3-year or 5-year, whatever time frame you decide, after that, the amount of performance which you could achieve by a long-term investing versus a DIY investing, the cost which you are incurring is much higher compared to what you would have incurred, let's say, based on a goal-based investing plan, or the kind of efforts you are putting. Again, when you invest yourself, you need to put a lot of time and energy into it. I'm not sure how many of us have this capacity and the bandwidth to put that kind of time with our own jobs, business to take care. So in theory, in a bull market, it looks very easy. I can do it myself, but trust me, over a long period of time, while working with the hundreds of investors, I have realized it is a very difficult thing. Managing with your own business to maintain that temperament, maintain that discipline is a very, very difficult task. And but in case of some rare people who are very passionate about investing, would like to make want to create a long-term wealth creation portfolio and who are thoroughly inclined towards it, maybe for them it could be a great idea. But for 90% of the people, again, I came across a survey wherein almost 90% of our people who have done a stock picking has underperformed the index, as well as 83% of the large cap mutual fund also we know has in the large cap space have underperformed the index. So that's where the dilemma is. 76% of working professionals are also requires a expert advice on their portfolio. So looking at all these data which I see across, it's very difficult to manage that portfolio yourself.
You know, you did that data analysis. We also are running a poll on CNBC TV18 social media currently for our show Mad About Markets. And there we realized that 8 out of 10 investors are sub 40 years in terms of their age. And almost half of them get all their ideas from social media or research from all of that as well. Everyone's talking about, every platform, every influencer, every website is vying for the investors, the DIY investors' attention. They're also suggesting their own set of asset allocation ideas, funds and stocks. So how should one cut through the noise? You're talking about focused approach, goal-based approach. You're talking about behavioral management. But in this age of information overkill, how does one cut through all of that noise?
Right. So I'll give you a very small example. 20 years before, if you would have invested, let's say, a 10 lakh rupees into 8% fixed deposit, the value of that 10 lakh rupees would be worth almost 50 lakh rupees. If you would have invested that money into, let's say, a high performing stock like HDFC Bank, the worth would be 5 crores plus, right? So the alpha and the delta is there, right? We all know that. But the problem is how many of us have this temperament and mindset to invest for that kind of mindset, right? For that long-term period. So the most important part for that goal-based long-term investing is identifying suitability. What is suitable for me? For that suitability, the most important part is identifying what are my long-term, medium-term and short-term goals. Identifying what is the kind of risk I am ready to take. And risk, again, is a very relative word. In the bull market, the risk tolerance level is very different. In a bear market, when I come across investor, it is very different. So risk is a very relative word, and one need to be a very pragmatic person when you look at risk. And again, I'm getting a little philosophical, but I will give you a quote: getting rich versus staying rich. It's a very difficult thing. Most of us can want to get rich quickly, but how many of us can stay rich? And again, for that, you need a constant behavior management. I remember a story of Jesse Livermore in 1929. He used to be one of the finest trader in the Wall Street. And he in today's currency, he made $3 billion in one trade. And 1933, he made some high leverage bet and he almost vanished after that. So that is the story, right? 90% of the traders are not able to beat the index. And that is where they incur huge losses and time bandwidth. So a goal-focused investing gives you a lot of peace of mind. It makes you focus on your work, what you are doing. And ultimately, wealth is all about peace, according to me.
All right, Tarun, thanks a lot for that. On that poetic note, what we'll do is we'll take your leave. Thank you, Firoz and Tarun, for stopping by and helping all our viewers with their investment goals. With that, we run out of time on this edition of Mutual Fund Corner. You stay tuned. Closing bell will take you through the last hour of trade.